Welcome to my live stream. It is January 15th, and the market did trade higher, but it was not an equitable rally for all stocks. We had semiconductor stocks rally really well on the news that TSM had very good earnings. They expect to sell or produce a lot of semiconductors in the first quarter of 2026. So it sent a lot of stocks rallying higher. But some stocks really struggled. If we look at, let me get the heat map up, and we'll see that semiconductors, especially the semiconductor companies that provide support materials for semiconductor companies, did really well. But the market still dislikes software companies, just really bringing their prices down. This is a tiny little box now representing that their valuations have really gone down over the last 2 years. And the pain was felt by Microsoft, Apple, Google, and Nvidia went higher. AMD went much higher. So looking good for semiconductor companies and server companies as well. Looks like Arista Networks had a good day. Over in industrials, we had a pretty good rally across the board. That looks pretty good. Amazon was a little higher. Meta was a little higher. Health plans really took off. United Healthcare. I know Oscar Health was up about 7% for part of the day, and then it settled at around 4% higher, which is still a really good day for Oscar Health. So it wasn't a perfect day for all stocks, but when is there a perfect day like that, right? Sometimes some stocks rally and some stocks don't. The other thing that I noticed was Citigroup rallied much higher, and capital markets. So this is Goldman Sachs. They announced today, and I'm not sure which one this one is, but their earnings were good. So some stocks really rallied higher and some stocks really struggled. Eli Lilly struggled. That's a rarity. Looks good. The earnings, we are in the first week of earnings, and the biggest one today was TSM. And TSM announced really good earnings. I covered it. I created a pretty lengthy video analyzing TSM. I released it out to members of the channel that are advanced members, super members, and platinum members. So take a look at that video if you get a chance, and if you're a member of that level. Other companies that announced, Goldman Sachs. I guess we can look at Goldman Sachs. Morgan Stanley, let's take a peek at that. BlackRock, that's a financials company. After the market closed, JB Hunt, let's take a look at that. They're more in like logistics. So it'll be interesting to see from a economy perspective. And tomorrow, what do we got in store tomorrow? We've got a pretty good sized bank, PNC Financial. I think they're in the Northeast, State Street, M&T Bank. So we got some pretty good number of regional banks announcing tomorrow. And they should do well with lower interest rates coming. So it's going to be a big day for financials tomorrow. Mid-market, or I should say small cap financial companies tomorrow. There's going to be a lot of them announcing. We'll see how it goes. Looks like we've got 12 people on, and Shadow Guy kind of made an appearance earlier in the stream. Just wishing us a good stream. Good to see you there, Shadow Guy. If you're on the stream and you want to look at a video, that'd be great. Let me know in the chat. If you're a member, it comes with your membership. If you're not, just pay me a $5 super chat and I can take a look at that company. We will analyze it. Got a variety of tools. Let me show you the Super Investor terminal. So super investors get access to this terminal. It comes with a complete listing of my portfolio, what I'm buying, what I'm selling. It has a complete dissection of my portfolio, what stocks I'm owning, what percentage of my portfolio I own, and what sectors I'm invested in. Biggest sectors, communication services. I own Google, Meta, Reddit, AppLovin, and that makes up most of my portfolio. Second is technology, bonds. Got some money in China, financials, healthcare. So you can look at the details of my portfolio to become a super investor. Also list out the buys and sells that I have actively each week. I have a very extensive watch list with more than 350 stocks that are listed, the research and valuations on every single stock. And I think you might be having trouble seeing. Now you can see it right there, or I should say right here. You can look for any stock. Like we were looking at Exxon, and it's XOM. So we can look at Exxon here. Here's Exxon's complete valuation as the last date. I researched TSM this morning, and Shazam, it is there. It's available real time. We can look at companies like Meta. Every company is listed in here. You can see my research. So that's what super investors view. Take a look, see if it's a program you want to be a part of. Advanced members get a complete listing of all the stocks that I've researched, and they too get to see real-time valuations. And if I update a valuation, they get to see it, which is, I hope, really useful for people. You know, getting research, real-time research, and then being able to ask me questions. I hope it helps investors that are subscribing to the advanced investor level. And if you're above that, like a super investor or a platinum investor, you get to see everything as well. So take a look. Hopefully there's something there for you that you would find interesting. It'd be great to have you as a member. And of course, on live streams, you get to ask for stocks to be reviewed. So that's an added benefit. All right, so let's take a look at some of these stocks that have announced while people think of what stocks they want me to look at. So Goldman Sachs was up 4.63. That's really good. It's a good day for Goldman. For the year, the stock's flourishing, up 70%. Man, that's really good. And for the 5-year, up 216%. Man, what else could an investor want? This is doing terrific. I'm not an investor at Goldman Sachs, but it's looking at the rearview mirror. It's been a winner. From every angle we can look at it, it's been a really, really good stock. When we look at their business, is it growing? Is the top line revenue growing? Yes, it is. It's we got full years now because we're in January. They probably announced their fourth quarter. So it looks like they grew by 13.86% in 2025, 15%, 2024, and then a tiny bit in 2023. In 22, we had that bear market, so they weren't doing as well. This is a big outfit, $59 billion of revenue. That's a pretty big company. So that looks good. Top line revenue looks really good. It tells me that, you know, other clients, businesses want to do business with these guys. They want to do commerce with them. They want them to help them maybe refinance some things, do some private equity deals, IPO, all those things that Goldman Sachs can help with. I think the market for private equity is really growing, and I'm sure Goldman Sachs has got some wealthy clients that they tend to. Looking at what analysts are thinking, they think it's a little expensive right now. The stock's really flourished. So that's kind of logical that, hey, as the stock goes up, it's probably getting a little expensive. And what I really like about Stack Analysis is they give us a nice forecasting tool built with analyst forecasts that are out there. This is a big feature. I really like this feature in Stock Analysis. 31 analysts are putting their thoughts together. They're saying, hey, this is what I think Goldman Sachs is going to grow by this year, 8.4%. Their earnings per share is going to grow by 9.5%. And then in 2027, next year, 4.6%, and then almost 12%. So the growth is going to slow down for Goldman Sachs. So that'd be a little concerning. And there's actually kind of a flat period. So if this holds, I would venture to think that, hey, this stock's going to struggle because that's just not enough growth. You want some growth to exist. We look at the PE ratio. You got a forward PE here of 17, and that's an okay PE ratio for a company like this, but their growth is 9.5. You would want a PEG ratio, a PE growth ratio, which is basically your earnings per share divided by your growth, and I'm sorry, your PE ratio divided by your growth. You would want that to be below 1, meaning your growth rate is higher than your PE ratio. So in this case here, it's going to be well above 1. So that's not going to be a very attractive ratio on the PEG ratio. So Goldman Sachs is looking a little too expensive and probably a stock that I would stay away from. Not a stock that I'm all that crazy about. It's hard to figure out Goldman Sachs. I'm sure, definitely some investors have figured out the stock and have flourished really for the last couple of years. They've done great. So that is Goldman Sachs doing great today, really flying up. Another company in financials is BlackRock. And BlackRock is publicly owned investment manager. The firm primarily provides its services to institutional, intermediary, and individual investors, including corporate, public, union, industry pension plans, insurance companies, and third-party mutual funds. Okay. So these guys are really servicing institutional investors, big investors that have big treasuries that need to be invested. They have market cap of 188 billion. Its PE ratio, forward PE is 21. Current PE ratio is 29. Analysts think there's a small discount for the 1 year. These guys have gone up 20%. 5 year, 55%. They do pay a dividend of 1.8%. Looks good. Their growth looks really good. Top line growth is looking good for the trailing 12 months. Looks like the last full year wasn't loaded in stock analysis just yet, but that's looking good. It's very healthy growth. This is looking pretty darn good. And looking at that forecast again, stock analysis does a nice job of giving us good forecasting information from a variety of analysts that are putting their thoughts out there. Plenty of analysts covering BlackRock, and they have very good revenue growth, 19.2, 16.7, 11.2. Very good growth. The PE ratio 21, growth rate of 13%. These are good numbers, very solid numbers. So I could see BlackRock being a pretty desirable business. Not the right business for me, not my strong suit on understanding these types of businesses. But today, the stock really flourished. Investors really liked what they saw and think the future for BlackRock is going to look really good. Looks like we got Ben 10 on. Ben 10, good to see you. You want to look at EA DSY and then MEG. Never MEG. Doesn't sound familiar. GSL. I have a feeling these are going to be small caps. And CNTA. All right. Good to see you, Ben 10. All right. So let me finish off on JB Hunt and Exxon. Then we're going to hit that list that Ben 10 put out there. So JB Hunt announced, and their stock's really trading lower. It looks like their announcement was poorly received. Revenue falls lower on intermodal sales. Got it. So they're just not moving as much freight as the market expected. It's a really small cap, 19.66. I believe they're an industrial stock, industrial integrated freight and logistics. Got it. They do have the full year financials loaded, and for the full year, they didn't grow. This is a problem. And it's interesting that, our economy's been doing all right, especially when it comes to logistics. There's been a lot of there's been a need to expedite freight for the last couple of years. So I would have thought these guys would have caught some of that revenue, but they haven't. And when are they gonna rebound? Looking at the forecast for these guys, analysts think they're fairly priced, just a little overpriced. And when we look at their growth for the year we just covered, they were in a kind of a slow growth period and are coming out of a drawdown over here, I should say, a slowdown. But they're expected to grow. This looks pretty promising here. Growing 6% in 26, 6.6 in 27, and then 8% in 28. That looks pretty darn good. Look at the growth of earnings per share. This looks very good. So if we look at the growth of earnings per share in 26, this is going to look good. It's probably going to surprise to the upside in the current year. But we got to look at the earnings for this business because the stock's really selling off. These numbers look terrific, by the way. So what is going on with their latest earnings report? What did the market really dislike? Let's look at the actual financial statements that the company produces. Because sometimes, I like to kind of hear it from the horse's mouth. Like, what did the company announce? And do I like it? Because maybe the market's looking at ratios and I want to look at the business. So here is their site. Where are we going to see? Let's see, quarterly results. Let's see if that's where we're going to find the earnings release. Here we are. So here's the Q4 earnings release for 2025. And here is JB Hunt. So the fourth quarter revenue was down 2%, and Stock Analysis was expecting it to go down a little bit, like 0.5%. But that's maybe part of the bad news is the revenue really missed, and that could cause the stock to really sell off. For the full year, it was down a full 1%. And we were only expecting that it was going to, let's look at the forecast here. I think this is where it was listed. For 25, we were expecting that they were going to contract less than 1%. So it's just slightly above that. Okay. So for the full year, profits were up by 10%. Operational income was up by 4%. So that looks pretty good. These guys are headquartered in Arkansas. See if they did any kind of guidance. Guidance, no. Looking for keywords here. See if I can find anything on this company. And give me a minute here. I'm going to scan through this, see what it looks like. So cash flow. All right. So I'll look at that over here. Let me hit refresh and we'll take a look at their statistics. I want to look at their debt level. I'm not sure if these guys carry a lot of debt. It looks like they do carry about $1.45 billion of debt. The debt to EBITDA is not a problem. It's less than 1. So long as it's less than 3, then I'm good with the balance sheet. And these guys look to be okay. The gross margins, okay. These guys are doing a service, a logistics service. That looks okay. And they are not providing cash flow here. I wonder why. That's a surprise. So the year prior, well, I guess we'll go back to this guy. So here they're quoting that they're here. Okay, this is what they bought back shares. That is good. And here they're okay. They had this is their debt. I already went over debt. Okay. So they had CapEx expenditures of 275 versus 674 the prior year. But they're not saying what they had from cash from operations, which is kind of a surprise. Let's keep going through the financials here. All right. So I'm good with the income statement. Here's the revenue. Okay. They're telling us about their business, what portion is going where. Here's the balance sheet. Their debt's okay, not a problem. So they didn't give me the cash statement. All right. So we'll have to move on from that. So this one looks interesting. I'll tell you why it looks interesting is, if we look forward, this may be an opportunity. The growth in revenue looks good, and the growth in profit looks really good. So this one here, I'm going to lock in, and I'm going to do some more research on it because this one might be interesting to keep an eye on and invest at the right time. The company over the 1 year, you see that the stock was beginning to rally higher. I think investors were looking at that forecast and really liking that forecast. You see the stock's kind of gone sideways. Overall, it's up 36%, pays a small dividend. But boy, if this thing comes down, it might be an opportunity to catch this at, I don't know, $100, $180 per share. And this thing can rally higher because its forecast is looking good for the future. So I'm going to note this guy and make myself a note to research this stock further. I'll pop it into the analysis. And again, those that have access to the terminal, the super investors or the advanced investors, you'll be able to see that valuation once I complete it. I'll do it in my, off the air time. But if you're a member, look for that to be updated. All right. So let's get cracking on Ben 10's list here. And we'll cover EADSY. What does that company do? EADSY. Airbus. Okay, this is an aerospace company. I know them because they make a lot of commercial aircraft that the airlines buy, and they also do defense equipment. The airplanes and aircraft for the defense departments in Europe, primarily because this is a European company. I believe they're headquartered in France, but they have operations and involvement from European countries like the UK. I think Germany's involved, Italy. All those countries are involved with Airbus. These guys are a lot like Boeing. $198 billion in market cap. Forward P of 28. Stocks really work for the 1 year. 5 year, it's really worked. 121% upside. And you see that I really like the trajectory of their stock price and their stock rally. That looks really good. Their growth, single digit for the trailing 12 months. It was better a couple years ago. When we got out of COVID, the airlines needed to refresh their planes. They needed to expand capacity because people really wanted to travel. They do have positive cash flow. I do like that they've been growing it a little bit. 3.5 billion. This business just right out of the gate is going to be worth about 70 to 105 billion dollars minus debt. And see that they have low margins. Gross margin is 15.5%. Overall net profit margin is 7%. So it's not a very profitable business. Aerospace and defense is not very profitable. It is a big necessity, but it's not very profitable. When we look at their balance sheet, let's see if they got almost as much cash as they do debt. Nice job, Airbus. They don't have any debt problem. Good job. Good job. So that looks good. Cash flow, we already went over that. So their free cash flow. I'm not sure why I'm seeing a different number. So okay, so the free cash flow listed here is different than what was listed on that other page, which is strange. All right. So looks like we have our first super chat. Good to see you, Scott. I'll be with you in a second. So this stock is worth 80 to 120 based on the other free cash flow number minus debt. They really didn't have any much debt. So these guys are just bid up a little too high for me. They've been doing well for 5 years, but these are low margin businesses, right? This is not, uh, a technology company like NVIDIA at 70% gross margins, really healthy profits. No, it's not the case. So I'm careful with businesses like this. I'm not quick to buy into low margin businesses. I have to be receiving a very good discount. There's no discount involved with Airbus. So for me, Airbus would be a pass. It's been rallying higher on the whole storyline that, hey, Europe's going to have to build up their defenses. I'm sure that's going to be the case. But those governments are still going to watch their spend because they don't want to overspend. They won't get reelected, and they'll have to watch how they go about things. So that's my comment on EADSY or Airbus. All right, so Scott wants to look at MOD. We're going to look at MOD next. And it looks like Kurt has made an appearance on the live stream. How you doing, Kurt? Great to have you on the member call, by the way. Last night, it was good to have a good conversation. Let's take a look at CRMD. CRMD is a healthcare company, and it would be a good thing to take a look. So we'll look at that one as well. Herdo, good to see you. Great to see you. And Ben 10. Yeah, those low margins, they kind of scare me. I'd rather, we get to invest in whatever business we think is the best one that's going to help us grow our wealth, take our hard-earned money and turn it into the highest, performance possible. And I like those high margin, high sales growth, those types of good, strong fundamentals is what I'm looking for. So right now we're going to look at Modine Manufacturing. This is a request from Scott. Let's get into it. So Modine Manufacturing designs, engineers, tests, manufactures, and sells mission critical thermal solutions in the United States, Canada, Italy, Hungary, and the United Kingdom, China, and internationally. So the company offers heat transfer products, including round tube, plate fin construction, gas-fired, hydronic, electric, and oil-fired unit heaters, roof-mounted direct and indirect fired makeup air units, duct furnaces, and infrared units, perimeter heating products, single package unit ventilators. Let's take a peek at their website, see some visuals to get our head around what this business does. Okay. So it seems that they're an industrial company manufacturing, designing products that are going to help us cool data centers, heat up buildings, and so forth. Heat exchangers are very efficient. Okay. So this is very, very important right now with data centers. Some businesses that are in cooling, their stocks are flying off the charts. So these guys may be right there with them. So I'm going to go ahead and let's see here. I'm going to pre-open this just to see if we can look at it later. All right, so I understand high level, but I'd like to look at their solutions a little bit more. So we got that. Okay. Let's take a look at our solutions here. So thermal management systems. Okay. So you see industrial buildings there. Now we're in a data center. Got to keep those servers cool so they don't overheat. Here's what looks to be a hospital, laboratory environment. Wow, look at those. Look at those units. Okay. All right. So we got agriculture, construction and mining, commercial indoor air quality, commercial vehicle applications, data center cooling, e-mobility. So, yep. All right. So they're across different markets, different use cases for what they do. So this is a $6.9 billion market cap company. Stock isn't all bid up, but it did get bid up over the last 5 years. Looks like a lot. The stock really went on a run starting in 23. That's when it was probably discovered as a critical company to a data center and other applications. But for the last year, it hasn't flourished. If you measure the 1 year, although if you would have picked it up when it sold off, you could have picked up shares for $69 per share and almost doubled your money in less than a year. So let's keep going here. Looks like Braden's on. Dave is killing you. We'll take a look at Dave later. All right. So let's keep rolling with Modine. And I don't know if it's Modine or Modine, but hopefully one or the other. Now, when a stock does this, right, 845%. Now, companies like NVIDIA and others, they have made me accustomed to, okay, stock does this. So when I go to their revenue growth, I see real big numbers. It's like, okay, this is rational. These are giant numbers. Incredible. So when I go here and I'm like, okay, the stock's really bid up. Where's the growth? You're putting up 8% growth and your stock did 800% appreciation. So it's a little bit of a letdown there. And it's a concern. Are we just buying because of the story? Oh, they're in the data centers, so they have to be valuable. Well, they're not really growing that fast. And this is an industrial stock. They make a product, so it's not like they're making a big margin product. And again, let's go to NVIDIA. So here's NVIDIA. Growing by 65% after they grew by 114, after they grew 125. So this sequentially, they went from, in 22 being a $27 billion company. Now they're $187 billion. That is such incredible growth. And they're doing it while having these real big margins, gross margins of 70%, profit margin of 53%. Those are staggering numbers. So let's take a look at this company. This company, Modine, has got margins that have expanded. This is good that they expanded them, but we're up to 24%. Nowhere near like an NVIDIA, nowhere near that. And their profit margin 7%. Free cash flow 1.5%. So it's like, man, the market really loves the story, but I'm not liking the fundamentals at all. These are just not very good, chunky numbers. I'm not seeing a lot of profit. I'm not seeing a lot of cash. The free cash flow is $41 million. That's why their yield is so low on free cash flow, 1.5%. If you went to the bank and put your money in the bank, they said, hey, we're going to pay you 1.5% on your savings, you'd probably be like, man, I'm going to start looking for a new bank. That is not competitive. I can probably do 3 or 4% on a money market account. Maybe even higher if I go into bonds or a bond ETF. So why would I stick my money in a company that's going to have a riskier profile and the cash flow isn't there? So not liking this business because of the cash flow. And they have not proven to be a cash flow generator in the past. Let's keep looking. So analysts think it's highly discounted. Analysts are looking at earnings per share. And earnings per share is a good number, but it could be deceiving. A company can look profitable, but not really be generating a lot of value. Cash flow is the best measure of value. And here we're operating in the year that's going to end here on March 31st, 2026. It's soon to be a completed year. Their growth is expanding. If they hit this forecast, and I've got some of their information open, so we're going to look at this in a little bit. Then they're going to grow at 15.4%, and then 16.39. Their earnings per share will expand, so that looks good. And the forward PE does look good. Now, their ratios look really positive because you see that the earnings per share growth is higher than their PE ratio. So this is going to have a very good PEG ratio. So this is probably showing up quite nicely for investors that are just purely investing on those metrics. And those metrics are fine to look at, but you got to look at a business holistically. And this one here is just falling short of that. The cash flow just doesn't exist, which is my biggest problem with this company. Let's take a look at their balance sheet, and we'll do a quick valuation on this one. So the balance sheet here, we've got debt of $689 million. They've got $83 million of cash, so about a little over $600 million of debt. I don't think that's excessive debt. It's only 1.6 debt to EBITDA, well below that 3. So the balance sheet's okay. All right. So did they pay a dividend? No dividend. Okay, that's fine. So this one here is looking a little expensive. Let's look at their financials just to make sure we see everything that should be taken into account. Pretty impressive operation here. Wonder what this is. This looks like a big plant of some sort, and they're doing some type of heat exchanging. All right, so the second quarter, this was announced October 28th. And they grew by 12%. That looks good. See if I've got my, I don't have it. Give me a second here. Let me see if I can. All right. So they grew by 12%. That is a good growth number. Fiscal outlook for the whole 2026, and they have a fiscal year that ends at the end of March. That's what they're referring to. They're going to grow between 15 to 20%. And they increase that outlook from 10 to 15%. They increase it up to 15 to 20%. Okay, so what we'll do is we will put this kind of an evaluation model and see how it values. Now, what businesses do I have that are similar to that one? So I'm looking at industrials and see where I can find a similar business, and we'll take that as a starting point, and then we'll work off of that. So Carrier, this one would be very similar to them. Carrier does not have a discount, so that'd be a good one to compare it to. So we're going to go look for CARR. Okay, Carrier is right here. I'm going to make some room. I'm going to copy that valuation and put it in here, and we'll see where that valuation lands. Carrier we analyzed on January 2nd. Carrier is similar. They do a lot of cooling. A lot of commercial buildings have Carrier units. They also do a lot of other forms of cooling. So Carrier is all over that space as well. So this is MOD. Today is the 15th. the balance sheet was okay. So I'm going to go 7.5. So this is where it gets pretty tough because they don't have very good cash flow and they don't have a history of having good cash flow. So when we look at their cash flow, it's 41 million for the trailing 12 months. The year prior was, and their year prior was fiscal year 25 that ended in March of 25, 129, 126. So I'm going to give them the benefit of the doubt. Valuation. And they're growing quite well. So 129, and they were growing by 15 to 20%. So we'll grow by 15%. They're seeing very good growth. So we're going to grow that cash flow by 15% in 2, 3, and 4. And that's going to give us a intrinsic value of 5.2 billion. They had a little bit of cash, and what I'm going to do is I'm going to open up that stock analysis information you guys were seeing in a screen that you guys can't see, just so I can look at that screen and then just update some information on the valuation model I've got open. So the cash on the balance sheet was 83,800,000. And then the debt was 689,500,000. So we're falling short of the valuation. This is really giving them like every benefit of the doubt. And this is the most optimistic forecast I can give them. And I'd rather go with a less optimistic forecast, really, because it's my hard-earned money that's being invested. I don't want to take excessive chances. I want it to be a very clear opportunity that these guys are going to make me money. Now, these guys, their year is going to end March 31st. So I'm not going to go with the current year earnings per share. I'm going to go with next year's, which is $6.41. I'm going to go with an 18 PE. That's adequate. I'm not going any higher. They have low margins. And after next year's close, you're supposed to grow by 30%. So I'm going to grow that by 20%. So yeah, I think it's fairly priced, and actually with the discount if you look at earnings per share. But I look at it from both an earnings per share valuation and a free cash flow valuation. And if you study some of these big investors, they really just look at cash flow. They don't look at earnings per share. So this one here is priced 24% too high. That would be a pass for me. It's priced too expensively. I believe that we're in an AI bubble, but this bubble could exist for a year, 2 years, and eventually we're going to have a correction. I think we're going to have a hard time digesting all the data centers that have been built. And these data centers, they require a lot of power. And some of these communities, I mean, they don't want 20 data centers in their cities and taking away resources from hospitals and homeowners that maybe their electricity bills are going up. So I think we should see some type of pause in that whole data center build. When's it going to happen? I don't know, but that's how I feel about it. So this one here, I'm going to store it on my watch list. It is an interesting company. They're involved in the data center. So they've been a popular stock for investors to take a look at. What I'll do is I'll put it in here right next to Carrier. When I add this here, it gets added to the terminal that super and advanced members will have access to. And that's important. That way, if somebody is interested in Modine 24/7, they can look at this stock. So we're going to go with do not buy as kind of like my rating. It's a small company. It's in the US. I'll copy down their stock price. And then the intrinsic value per share is what we just came up with, and that is $100.55. And we've got a price delta there. And it's priced a little too high by 24%. So I've updated the information on Modine. And now if we go over to the terminal and let's say an investor coincidentally was like, hey, I'm interested in Modine. And they could just look it up and Shazam. We just updated that in real time. Investors can look at my research. So both advanced and super investors get access to that terminal, by the way. And there's over 350 valuations on there. So thanks, Scott, for asking about Modine. It certainly is an interesting business. It's just for me, as I look at a businesses fundamentally, I measure them by how much cash they're going to produce, their margins. Are they a very attractive business like NVIDIA, or are they very low margin businesses, which could be a problem over time? Their valuation for Modine is really bid up. They're really caught up in the data center story. And some of that's well-deserved. Their revenue is growing, but it's just not a stock that I would want. It's just the margins are not good enough. So that's my opinion on it. And I really appreciate you sponsoring that company. Never looked at it, and it is an interesting one. All right, so looks like Shadow Guy is making an appearance. How you doing, Shadow Guy? All right, let's keep tracking here. And let me make sure I didn't miss any comments. We got that good. All right. Ben 10. Chime is performing well. I think, the companies that are buy now, pay later, they're not subject to that whole, I think there's a idea in government that they want to hold credit card companies to a certain maximum that they could charge on credit cards. But the buy now, pay later programs, they don't deal with interest rates. So they're going to be kind of immune to that. That's going to be an advantage to them. So I could see Chime really rallying on that news. Shadow Guy. I think Barclays looks good. I think they're, and we could take a quick glance at that. So Barclays is a big bank. They're UK based. And I think their symbol is BCS. And what we did is we ran these ratios. So they're a big bank. They're in the UK. And when we look at big banks, and I did a video, I guess 2 days ago, and Citibank announced, Bank of America, Wells Fargo, UBS. I think UBS announced, and then JP Morgan. But when we look at these ratios for banks, we want this book value. We want the best book value that we can get for the stock price. We want the price to book to be as low as possible. You see that Citigroup's looking really good, but looking even better is Barclays. Barclays has a better price to book. P ratio, better than anything listed up here. So the 1 year return, 101%. So yeah, it's looking good. It's looking real good. So that's my answer to you. Looks really good. Man, John Rogers, stepping up big. Thank you, sir. And you want to talk about Intuit? I would love to talk about Intuit because, I'm going to talk about software companies a little wider than just this one stock. I'm going to focus on Intuit, but then have comments around software as well. And Zubio, are you looking forward to oil stocks? I don't know. It's all about oil prices. And if oil prices go up, boy, oil stocks are going to go up. I just don't know what's going to happen. There's certainly a lot of news stories on the hopper with Iran and Venezuela. So we'll see how that works out. All right, let's get cracking on Intuit. And everybody else, I've got a list of stocks going. I will cover them. Let me just get to Intuit right here. So Intuit, I know really well because I've been an Intuit customer for 30 years through TurboTax. Um, I professionally have worked in software for a long time, and I'm very familiar with their QuickBooks product, which is a product for smaller businesses to use to do their accounting, principally to do their accounting. And it does a couple other things like purchasing and uh, you know, keeping track of assets and so forth. And now they also do MailChimp, and they do a couple of other services. They have a personal finance tool as well, but their big products are TurboTax and QuickBooks. And those have just been awesome products for these guys. And when you think about how they do business with QuickBooks, it's a lot of small businesses. So their strength and their moat is that they just have such a big business of small clients coming to them that it's going to be very hard for anybody to disrupt them. So let's take a look. It's got a pretty good market cap. Over the 5 year, it's up 52%. It has had a pretty strong pullback in the past year. I mean, the stock got to $800 per share. Now it's down to $554. It caught my attention when it was doing this because I have a lot of respect for Intuit. Let's take a look at their fundamentals. The company pays a small dividend. Forward P 23.38. And analysts think it's highly discounted. Okay. They're going to announce on February 24th. So we're a month and a half away from their earnings. Now, this I really like 17% growth. That's very good growth. 15.6. This is a pretty good sized business, $19.4 billion of annual business. And 15.6, 13.3, 12.9, 32.11. And this is a number, I think in here was probably the acquisition of MailChimp. They acquired MailChimp, and then they acquired some other personal finance company. But you can see that they are just growing. This is very good growth for a good-sized company. Now, the Rule of 40 will apply that to these guys. That's 17. We want to add 17 plus their net profit margin. And when we do that, let's go down to the net profit. Net profit's 21. So 21, 17, 38. If you eclipse 40, it's deemed to be a very good investment. So these guys are near that key threshold or milestone of being classified as a really good investment. Let's keep going. Here's some things that I really like about Intuit. So they're growing their top line revenue. Look at this gross margin number, 80%. That's phenomenal. Profit margin, 21%. Phenomenal. Free cash flow, 32.9. I love these numbers. Really love them. That just means that they get to keep so much more money when they sell an additional $1 million of revenue. They get to keep a lot of it in their balance sheet in the form of profit. So that looks good. Their balance sheet is in good shape. I'm an investor in Intuit, just to put that out there. Balance sheet, $3.9 billion of cash, debt, $6.86 billion. So their net debt is $3 billion, debt to EBITDA of 1. No problem on debt to EBITDA. And so we've got a strong balance sheet, very strong margins, and let's take a look at their valuation. All right, so I updated the valuation on Intuit back when they announced their earnings. No big information's come out since then, but on cash, these guys are discounted by 37%. On earnings per share, and I could probably tidy that up a little bit because that does change based on what analysts are expecting. And I'm going to open up the stock analysis website. Let's look at that together. That way you guys follow my train of thought. So we've got 19 analysts covering it. They think it's highly discounted. And when we look at their earnings per share, and we're also going to look at their future growth, we're operating in this year. That's going to end July 31st, 2026. It's expected they're going to grow about 15%. It's very good. Their PE ratio, their earnings per share is going to be $23.66. It's growing from last year quite a bit. And their forward PE is going to be 23.44. It's dropping to 20.5, and it's going to be growing by 14%. And so that's looking good. And you see their top line revenue growth. The next full year, that's going to begin August 1st, 2026, they're going to grow by 12.5%, and then 13%, 13.6. These are very good growth numbers, okay? And their profit's going to expand even faster, bringing down their PE ratio to the teens. Now, why is this stock under pressure, as well as a lot of other software stocks, is the story. The story that AI is going to disrupt these businesses. Now, these businesses, Intuit specifically, they provide software that a small business would use to do their accounting, to integrate with their bank and issue out payments to their vendors, keep track of their customer list. These are fundamentals to a business. And I understand AI quite well. I understand the software business really well. I've worked in it for a long time. And I just don't see how rational minds see that there's a disruption from AI into QuickBooks customers or TurboTax customers. The ability to, for example, TurboTax, I do my taxes on TurboTax, and in order to become validated by the IRS and every state government, you have to go through a validation process that TurboTax accomplished a long time ago. And TurboTax gives you access to the entire internal revenue, internal revenue code. And that isn't going to change. AI is just going to make Intuit TurboTax that much better. When I do my taxes, I'm sure I'm going to see an AI agent that's going to help me do my taxes faster, quicker. So I'm going to be happier with my TurboTax application. They're probably going to charge me a little more too. So it's an opportunity for Intuit. And these numbers, analysts are seeing this and saying, this is what we think the company is going to grow. Is it one analyst? No. 35, 34, 20. These are rational minds that are saying these guys are going to keep growing to the point where their PE ratio is going to come down. So the forward PE, the PE that I want to use, and the earnings per share that I want to use is $23.66, because most of that year is still remaining. So I'm going to use $23.66 in my valuation of Intuit. So it improved a tiny bit from the last time I had updated that. I'm going to use a rational PE ratio of 25. These guys are growing. I showed you their margins. If these guys were popular, it'd probably be a 36. But right now, it's a 25. They deserve it. Growth rate of 13%. I showed you the growth numbers. That number's okay. So on earnings per share, it's discounted by 17%. Analysts are a little more optimistic there than I am. But overall, when I combine this number and this number, and I have a blend where I put more weight in cash flow, and I add those two up, it's a 32% discount on an excellent business. There's one of Intuit. They are in a particular space in the market. TurboTax are dominant. Other businesses come after them or try to compete against them unsuccessfully. They're dominant. QuickBooks, they're also dominant. To the small business, QuickBooks is kind of it's like Microsoft Excel as it's used by accountants and anybody that's doing kind of spreadsheets. Excel is very popular as well as Google Sheets. And these guys, I think, are just being put into a category of company that the market deems is going to be disrupted by AI. And the expectation that, hey, companies are just going to use Claude to build their own software. Right. Okay. I'll believe it when I see it. And it's, I think, overly optimistic to expect that AI is going to be that much. But the market's the market. Intuit is really been under pressure. And I'm going to move over to Google here. Google does a nice job of letting me list out a few companies together. And we're going to see how these businesses I've known for 20 plus years. And I would say that I have, and sometimes I can walk and chew gum and sometimes I can't. Let me do this correctly. Bear with me for a second. And I want to hit this little compare button. And I want to compare it to CRM, which is Salesforce. And I want to compare it to Adobe. What's the last one? Let's see, Adobe. And the last stock that I'll put out there will be DocuSign. These are all software businesses. And let's go with over the 1 year, all these businesses have been under pressure. Different levels of pressure, but they're under pressure. Because the whole story is, AI is going to completely replace Salesforce. Well, I can go to Salesforce and look at their fundamentals, and similar to Intuit, growth, 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 high profit, high profit, high profit, cash flow, cash flow, cash flow. Adobe's the same story. DocuSign, the growth is a little slower, but it's still the same story. So we're caught up in that story. When will the story be proven wrong? I don't know. We're going to give it time and we'll see when it breaks. But for me, I'm an investor in Intuit. I'm holding my Intuit shares and I'm waiting for the market to, in essence, wake up that, hey, AI is not going to disrupt these businesses. In fact, these businesses can probably use AI and improve their products. So that's my feeling on it. I'll leave you with one more example. A lot of you guys have been coming to my live streams, members of this channel for some time. And let's see here. Would you consider buying more at these levels? Yes. Now, I'm going to share with you how I'm approaching it, just to give you kind of a bird's eye view of what I'm doing with my portfolio. Give me 1 minute, and I'm going to get to that question, just so you understand how I'm approaching it. Everybody's going to approach, how they invest their way. And here we go. And looks like Mike's on. Wix and Path are right in there with Intuit. Both have been really hurt. And we can take a look at those in a little bit. But, I made comments about Google a year ago, roughly. And I've got videos out there. I'm not going to assign homework, but the reality is that a year ago, I thought, the market's nuts. To doubt that Google isn't going to be a competitor, a player with an AI solution, or I should say, the story that was hurting Google back then was AI is going to take search away. And each earnings, Google is showing that we're growing search. We're growing YouTube. We're growing all our businesses. And this ended up being one of my biggest probably revenue or dollar generator for the last 12 months has been Google. 69% rate of appreciation over the 1 year. It's the biggest position in my portfolio. It is 11.6% of my portfolio. So it's a big stock. It's a big position. And it wasn't that big until it went up 70%. But I'll make my point as being is the market had this story. AI is going to take away search from Google. Didn't happen. Isn't happening. And Google actually came out with Gemini, and Gemini's gotten really good. Gemini looks great. So now the market's like, whoa, we're in love with Google again. And the stock's flourishing. And that's great. I think the same thing's going to happen to many of these software companies. Once the market realizes, holy smokes, we got these businesses that have 80% gross margins, 30% net margins. They're growing by 10 to 20% per year. Why are we not investing in these companies? I don't know. The market's kind of nuts at times. But the market's the market. Sometimes it takes a long time for it to correct. So how am I playing software? Now, we got to play a little chess and think 5 moves ahead, right? Now, I don't want to jump in head first too fast because as I just showed you on the graphs, the market may take its time. So I own Salesforce, Intuit, Adobe, and Okta. Okta has been working, and I've been buying into Okta. And this is not the percentage that I own in Okta. This is for the whole sector. Now, I am basically putting about 1% of my portfolio in Salesforce, 1% in Intuit, 1% in Adobe. And when the rally really gets established, I thought it was getting established, 3 weeks ago. Adobe was rising, Salesforce was rising. I'm going to double my investment there. So for now, 1%, 1%, 1%, and then Okta, I'm building it to 1%. I used to own DocuSign. I sold it. And I owned Wix for a short period of time, sold that. I had Path in my portfolio. And I just needed to get rid of one software stock. So I got rid of Path. I love Path. I love their business. They're not growing fast enough, but that's, I guess, one area of their report card that I don't like. But Wix is growing great. Really good business. So that's how I'm playing it, John. Like, when's it going to start rallying? I don't know. But like Google, when it does, I think it's going to really unleash a lot of wealth creation because it's going to realize, the market's going to realize, okay, you know what? We were neglecting a business that has gross margins of 80%, profit margins, free cash flow margins. I mean, these businesses are hard to find. We looked at an industrial business earlier. I think the top line gross margin was 25%. This is 80. The net profit line was 7%. This is 21. If I was going to buy one business or the other, Intuit would be far more valuable to me. So I'm going to stick with Intuit and my software stocks. I've worked in software for over 25 years. And I know perpetual licensing. I know software as a service licensing. I know this stuff really well. And I'm amazed that Intuit is going through this type of sell-off, as well as Wix and Path and all the other guys. Great to have you, John. Thanks for the super chat. All right. Now we're cooking with gas. So thanks, Shadow Guy. February 3rd for UBS. Yeah, so Path has got a rough time, but all these software stocks. And what's going on with Palantir? Palantir, they're considered an AI stock. The 1 year, these guys are still flying. 1 month, a little bit of a pullback. 6 month, for the 1 year, they're still looking really good. So there's a couple of like exceptions that continue to get a lot of investment. All right, so we handled Intuit. Let's go over CRMD. All right, CorMedix. So CorMedix is a biopharma company focused on developing and commercializing therapeutic products for life-threatening diseases, conditions in the United States. Its lead product candidate is DefenCath, an antimicrobial catheter lock solution to reduce the incidence of catheter-related bloodstream infections in adult patients with kidney failure. Okay. So we've looked at this company a few times. I just wanted to make sure I remember them correctly. So these guys do a catheter that helps in administering certain drugs for certain patients that maybe have an, a bad reaction to certain materials. And now, if I recall, these guys had good growth, but their forecast didn't look great. This is a small cap, 552 million. When we deal with small caps, these could be surprises or they could be full of surprises. Really low PE. Geez, below 3. What is going on? Analysts think it's severely discounted. So they grew very fast. In 24, they were a $43 million business. Now they're 214 for the trailing 12 months. They have very good gross margins. It looks like they probably license the patents that they have and they have somebody else manufacture it. They have very strong margins and very strong profit margins. So this is what I was concerned about CRMD is you had this huge ramp up, humongous, 628%. And then you plateau. This plateau is what I'm worried about. And I think other investors are looking at it going, hold on a second. Where's the growth in 26 and 27? What if they start contracting even harsher than that? So I think that's what's causing the sell-off is the lack of growth. It's there's better confidence in a smoother trajectory. They grew by 628%. Wow. And then they didn't follow it up with it, right? So if it was like maybe 50 or 75% growth, 50, 35, 30, that kind of smooth growth is great. These guys don't have it. This is the area of concern. So CRMD, some analysts would, but let me look at a couple of things first. Let's look at their balance sheet. Be curious to see. So they have a little bit of debt, $93 million of debt. I was going to keep track of how much cash they're accumulating. Sometimes these biotechs, they might have close to 40, 50% of their market cap in cash on the balance sheet, which would be pretty interesting. All right, so let's take a look at my valuation on CRMD, see if I can update any things on that. All right, CorMedix, highly discounted. Geez, look at that. Now, this is assuming that they're going to grow real fast, and I probably need to update these numbers. I think this should be a 10 and a 4. You saw that they're going to plateau. And I still think they have some room for growth because they're going to plateau, but they're still going to have good growth in 26 and then 28. These numbers look right. Let's take a look at their earnings per share, see if my number is still the same number that Stock Analysis has. And I'm using the earnings per share these guys are guiding for the next full year. And how I use like the forward earnings per share, FYI, now that we're at the very beginning of 26, if a company follows a calendar year, I'm going to use 2026 earnings per share. Once I get past the 6-month mark, let's say I was July 1st, I'd be starting to use 27. But some of these companies have fiscal years that are not aligned with the calendar year. So for those businesses, I would make adjustments following the rule that I want the most logical full complete year that I'm going to use for earnings per share. And the earnings per share for 2026 is $2.52, 18 PE, so we're good there. So the growth rate of 30%, that needs to be adjusted. So 252. Yeah, because it's supposed to contract in 27 and then grow again in 28. So I'm going to bring that down to 15. And this is what their forecast is showing, a contraction and a growth. So we'll just adjust it. It didn't make a big difference. So why am I not buying? It's discounted by 76%. It's a small cap. And I'm looking at it's almost like how attractive is CorMedix? Well, that slowness in sales growth is a big problem. Revenue growth shows that more customers are coming to buy the product. Customers like it so much, they're willing to buy more of it. They're willing to pay a higher price. It's all that good stuff. When you don't have growth, it's the opposite. Why are you not growing? Is your market limited? I think that's the key here is maybe they've sold into their full addressable market and there's no more room to expand. Well, that's a limitation and that's a problem. So that's why I'm staying away from CRMD. And it's been selling off. It's a small cap. Small caps are risky. No other way to put it. And I'll continue to follow it. And hopefully you found that interesting, Kurt. FYI, Kurt, I think United Healthcare went up today. And I know we talked about that last night. All right. So let's talk about Dave, because Dave has been getting under Braden's skin a little bit, if I may say. Dave. And, Dave's looking. I mean, I bought more shares of Dave for my son's portfolio on Tuesday. He's 25. He's got growth stocks. Great. Small cap. So Dave is a financial services company. And look at this sideways trade. It's been consolidating. Now, the good news is it hasn't been coming down. And look at that chart, man. Talk about the Grand Canyon, huh? This is exactly what it looks like. The Grand Canyon, if you've ever visited that national park. And what's it going to do next, right? We got an earnings announcement coming up on March 2nd. So we're a full month and a half away from this. There's a lot of things I like about Dave. Let's take a look. Let's update what we know about this company. So rule of 40, right? If you're above 40, well, these guys are already above 40 because 53. Are they profitable? Yes, they are. And they have very good margins, 71%. This is a small business. This is a young business. This is a new business. So I really like that. And actually, I'm prepping for, some growth stocks to keep an eye on in 2026. And I did a screen of stocks that should look good. And Dave popped up because of these fundamentals. Really good margins, really good profit, really high growth on the top line. So I really like that. Really like it a lot. The key to Dave flourishing is going to be they have to keep growing. Now, they grew by 56.88%. Growing by 18% is going to be okay, but okay is not going to get the job done. They have to grow above 30%. And 14% again is okay, but we're not here for participation awards. We're here for, I'm trying to find the next Robinhood, trying to find the next Palantir. And you got to grow faster to become the next Robinhood or Palantir or the next NVIDIA. So these guys make plenty of money, very good margins, and earnings per share look really good. Their P ratio looks fine. We just need to get this line to grow. Come on, Dave. Got to get that top line to grow. Let's do this. Let's go. And I'm going to close some tabs here. Let's see here. Yeah, we can close that. So I want to look at the Dave investor page. Let's hear this from the horse's mouth. So here's your third quarter. So this was the information they provided November 4th. Let me make this a little bigger. So Dave is one of the stocks that I'm thinking of buying in my main portfolio that I've been sharing with you guys. So let's take a close look. And Bo, I see you. Sorry for the wait. Good to see you, by the way. You want to look at ARM Holdings? Would love to look at ARM Holdings. Any change of heart in Uber? Nope. I love Uber. Love the stock. Okay, so we're on Dave. Okay, 63% growth. That's fine. Okay, so here's the guidance. So prior, they were guiding that, hey, our revenue is going to be 505 to 515. This is for 2025. And they guided much higher. Okay, this is a pretty good jump. This is probably about 39 to call it $35 million more for the quarter. That's a pretty good jump. Percentages are much higher. We need this to be kind of like a common occurrence. They keep raising their guidance. Like, hey, we're doing better. Customers really like what we're doing. So they want to do superior banking. So we're talking SoFi, we're talking Robinhood, hey, why do you want to work with these stuffy banks that, are hard to work with? So the TAM, so they're seeing new markets. So this is total addressable market. And they're seeing that, hey, we started off with a total addressable market being defined, but we're seeing other parts of the economy as being potentially markets we could go after. So that's what they're talking about there. That's good. So I like seeing that. I like seeing that these guys are, hey, we're out there growing. Interest rates are going to drop. Legacy banks, they charge high fees, right? So Chase, look at this. They charge all those fees, and Dave doesn't. Dave's like, hey, man, we're on your side. We're not out there trying to nickel and dime you. We want you to be a lifelong customer. Okay, good. Now these new businesses, right? They will perform circles around the legacy guys. The legacy guys are like stuck in 1995 when it comes to advertising. And these new guys are all over like Facebook and Instagram and Reddit and so forth. And that's where they're grabbing their customers. And that's the right way to do it. Oftentimes, like I'm doing business with my bank, and I really formed that relationship when I was like out of college. I was a young professional, set up my account. I still have the same account. Like I go to the same location. I lived in this house since 1999. Before that, I bought a house 5 years prior, and that's when I set up the bank account. But I've been going to the same location for the whole time. It's like I don't want to change because just the bank account. So these guys are going after the market when these, you know, younger people are setting up their lives, their financial lives, setting up their households. They're like, hey, this is going to be my bank. They're going with Dave. So that's good. So overall, I really like their business. This is kind of like SoFi. It's like Robinhood. So to me, it's a buy. Now, let's go over Robinhood, because Robinhood, it was not all like, ice cream and pretty balloons for the whole existence of the company. This is hard to see because the stocks flourished, but the stock really did sell off a lot. Okay. Sold off 81%. So Robinhood stock went down 81%. And then it picked itself up and it's gone up 1,162%. Welcome to small caps. Welcome to disruptor markets. So Dave is a new brand, new everything. They're not trying to do things the way other businesses were. Man, look at that. Jeez. Holy smokes. They sold off by 98%. Wow. And they rallied higher by a lot. 2,500%. Wow. What a chart. So long story short, with their valuation, meaning their market cap, I like Dave. Forward P 17. I think it's, and pardon it's worth the risk. If they could just keep it like exceeding expectations, raising their guidance, figuring out how can we go get more revenue growth? How can we figure out new products that our customers want? How can we disrupt more of this big, massive financial complex? Disrupt the JP Morgans, just disrupt the Citigroups, disrupt the Wells Fargos. They're going to be fine. And I think it's an opportunity right now. So that's where I'm at with Dave. And I know sometimes it takes time, man. It really does. But it hasn't been totally miserable, right? If you look at, back to Robinhood, right? This had to be miserable. I wasn't in the stock early, but if you're looking at your Robinhood stock and you're like, dude, I'm down 81%. Ugh, that's misery. I agree with you. That had to be horrible. And now the stock's up. Now Robinhood from its peak is down 26%. So it comes to the territory. You're dealing with stocks that are going to fly up. And right now, Dave is consolidating. So good one to keep an eye on. I am close to pulling the trigger on that one. Put some shares in my portfolio because I'd love to find the next Robinhood. Robinhood's been a real nice wealth creator for me. Looks like Tony is on. Tony, how you doing, man? Good to see you. And I just talked about Robinhood. So I think Robinhood's great. I think Robinhood is a long-term hold. I'm selling some of my shares, but don't take it the wrong way. I'm just selling because it's gotten too darn valuable and it's a risky stock. So I'm just pulling back some of my shares. I invested, I don't know, 30, 35 grand. The darn investment grew to over 200 grand and I've cashed in about 50 grand. So I've already got my whole investment back and then some, and I still own a bunch of stock. So that's what I'm doing there. And you're interested in Clar, that's another financial services company. Put that on the list for later. All right, let's get into what Bo wants me to focus on here. Thanks so much for the super chat. You guys are rocking tonight. A lot of super chats coming my way. I appreciate it. So let's talk about ARM. Today was like a giant party. It was like a rave party for semiconductor stocks and companies that provide the supplies to semiconductor companies. Now, ARM has not been in the party. It's like outside, the nightclub where the security guard isn't going to allow it in the party. ARM Holdings is there, along with Qualcomm and a couple other semiconductor companies. These guys, what they wanted to do was form a business where they're going to architect and develop compute central processing unit products and technologies around semiconductors. And the way I understand it is, let's say you're a company that is either, let me try to think of an example. You're AWS and you'd like to build some new semiconductors for specific workloads that are going to be for, let's say, for applications, mobile applications. You can design a semiconductor that would be optimized for that particular use case. And you could use ARM as a partner that's going to have the engineers, all the skills, the infrastructure to create that design. And ARM actually had a very good partnership with Qualcomm, and Qualcomm sells a lot of their designs. So that's what they participate in. They're not a semiconductor company. They're more of a company that will help design, and then they want to participate in the revenue share of those semiconductors. They are a $111 billion market cap company. When they came out, it was a new way of doing business, and they're a new issuance. SoftBank was a big investor, and for a while, it looked like they were just going to really flourish. They went from $50 a share up to 181, and then after that, it hasn't been as fun, right? And their forward P is 54. Analysts think it's highly discounted. Let's take a look at their growth. Growth is good. It's not great. 24.8 is good. They're a little small, 4.4 billion, right? It's not like they're, Qualcomm at 50, 60 billion. They're not, Broadcom at 100 and some odd billion. They're kind of small. 21.8 is good, but it's a small number. Gross margins, look at that. Wow. 97%. Hello. This is like Visa level gross margins. So their profit margin is 18.8 plus 24.8. We're above 40. This is an interesting stock. So I really like these numbers. I think as they get bigger, these numbers are they add up fast when you have these kinds of margins. So that looks good. Free cash flow, $1,151 million. And their revenue is only $4 billion, a little over $4 billion. So that's really good. Excellent. Okay, so that looks good. I don't think they have much debt. Let's take a look. Yeah, they have $3.26 billion of cash, debt of $429 million. So almost $3 billion of cash. And their market cap is 111 billion. Okay. So we're good on the balance sheet. Very good balance sheet. Analysts think it's highly discounted, 66% discount. And we're operating in this year that's going to end March 31st, 2026. They're growing at 22. They're going to keep growing at 22, 18.8, and 28.4. This number looks really good. So I'm really liking what I'm seeing. Really good expansion there. Forward PE. So I'm going to use this number because we're already within 6 months at the end of this guy. And this is $2.31, forward P of 45. All right. This looks really good. So right now, finding a semiconductor stock that is priced well is hard. I don't think I need to convince anybody of that. I'm buying into NVIDIA and I'm barely getting a discount. Astera Labs was a good pickup in 25, but I'm going to need to create a valuation, which I'm happy to do. Let's compare this one to, let's compare it to Broadcom. The reason I do that is Broadcom is a fabless semiconductor company, meaning they do not have a foundry. They go to companies like TSMC. They say, hey, we're going to design the semiconductors. We're going to own the patents for those semiconductors. Then we want you to use your foundry, that real expensive equipment you buy from ASML, and manufacture these components. And then we're going to sell them at a really good margin. So that's their business model. And now ARM is doing something that is similar to that, which is, hey, we're going to co-design these chips, and then we're going to charge a royalty when that company takes them to market. That's how they have an arrangement with Qualcomm. And I think it's a good idea. The balance sheet was excellent. Got no problems with balance sheet. They had pretty good cash. And I'm going to go ahead and open up a screen you guys can't see so I can kind of work through this data entry quicker. And their free cash flow was $1,151 million. Now let me work with their growth was pretty consistent. I'm going to revisit their forecast, and they were going to grow 22, 19, 28. So let's go with 20. And they are small, so we're going to go with that. Okay. So the intrinsic value is 80 million. They have, and I'm going to need to change. That's why these numbers look wacky, but give me a second here. So let's take a look at their balance sheet. Their balance sheet items were cash was $3,260 million. And the debt was 429 million. The shares outstanding, this is not correct. So let me get the Google lookup that I need to use here. All right, so we're not quite there yet. So the cash flow looks good. The growth rates look fine. Okay, so it's still a little expensive on cash. And it's interesting that the stock's been selling off. When I was looking at those numbers, I'm like, man, this thing's probably going to price really well. But that's why we do this modeling. That's why we put numbers, do the calculations so that maybe we are, like in my case, I was going to be way off on ARM. Like, oh, it looks discounted. I was wrong. That's why I have to do the arithmetic. I have to do the math, the modeling, and value the stock based on its fundamentals. So the earnings per share, $2.61. It's growing nicely. It's in a good category. So I'm going to go with the 28 PE. Growth rate, it is growing its earnings per share nicely. 33%, 29. All right, we'll leave it at 25 there. So I'm falling short of the valuation. So ARM Holdings is a pass. It is not ready to be the next NVIDIA, the next Broadcom, the next Astera Labs. Not ready. And I invested successfully into Broadcom in late 23. Sold it. I probably sold it too early, but I bought it. And then I invested successfully in Astera Labs in early 25. That's been an awesome stock. I've doubled my money in less than a year. So ARM Holdings is not looking like it's the next real big winner. Let's add it over to our watch list here, and then we can watch it, put it on this stack, because I'm sure it'll come up again. So let's put it right here, right underneath Micron. And then investors that are paid investors, advanced and super and platinum can see this valuation research. So thanks for sponsoring this, Bo. And while I'm at it, once I get done here, I'll take a look at semiconductor. I'll share with you where I'm investing. And it is very treacherous right now to invest in semiconductor because the darn space has gotten so expensive. If it sells off, man, it's going to sell off fast, because I think a lot of investors are going to head for the exits fast. They're going to be like, hey, I don't want to be the guy, holding on to the bag as it drops, 50% quickly. So exciting times are upon us. ARM Holdings. Okay, so I got that in there. Let me update this number. And now advanced members and super and platinum investors have access to ARM. Say you're an advanced member and you're like, a second after we finish, you're like, hey, I'd like to look at ARM Holdings. Boom, there's our evaluation. So you guys out there that are members, the tool is updating automatically. So hopefully you're getting value out of it. Now you're seeing that, hey, ARM Holdings is on the watch list. It is a listed stock, and you can research it. All right, so let me go back to this here, and we are good. Okay. All right, so we covered ARM Holdings. That was an interesting one. I was curious to see where that one was going to land. Thanks for asking, Bo. Good to see you. Dre, good to see you, man. I agree with you, sir. I think it is a good opportunity. Again, Tony, good to see you. I told you I'm still good with Hood. Clar, I put it on the list. So, Bo, isn't Dave expensive already? Not yet. I mean, if it's the same thing that you could say about like Robinhood or Palantir. If they keep expanding their businesses, the market cap's so low, it could continue to go higher. It's not very difficult for them to go higher because of the market cap. Now, it's a lot harder for Google to go higher because it's so freaking valuable, right? It's like knocking on the door of 4 trillion, right? So Dave can quadruple in value and still be a small cap. So That's what small caps bring to us, is the opportunity for it to be really, really a good winner. Whoa, got another super chat. Constellation Software. We are talking software tonight. I love where your head's at, because I think software is an awesome business. Software is so cool that 25 years ago, I decided I wanted to work for a software company. So I work for a big software company. And I'm really glad I did so. This is a Canadian company. The Canadians are really good with software. When we talk Shopify, that's a software company headquartered up in Toronto. Back in the days of Blackberries, Crackberries, as street name was, that's a Toronto-based company. There's a lot of smart people up in Canada. So let's take a look at this Constellation Software. I'm not totally familiar with these guys. Constellation Software, together with its subsidiaries, acquires, builds, manages vertical market software businesses to develop mission-critical software solutions for public and private sector markets. It's involved in the software licensing and sale of hardware activities. The company also offers professional services consist of implementation services, custom programming, product training, managed services, consulting services. They've been around for a while, in 1995. 45,000 employees. Okay. So it sounds like they're creating solutions for industries. Let's take a peek at their website. So it's good for me to look at the website, and here's why. Is Constellation Software kind of like a Microsoft that buys really good products and makes them better? And then when they go to a customer, they're like, hey, we're Microsoft. You can buy desktop tools. You can buy database licenses. You can buy cloud infrastructure from us. You can buy all kinds of things from us. That's a integrated business versus it's like a holding company. We buy a bunch of companies and let them run on their own, which is not as good in my book. So they have Valaris, which is in agri-food, biosciences. Okay. Harris, Jonas, Velo. Okay. They do mortgage technology. So this is kind of like it's a small ETF like company that invests in these companies. All right. So good thing I looked at it. And while I'm here, we're going to take a look at financial news. Ooh, they did not make this pretty. We don't need pretty. We just need numbers. All right. Get this ready. And let me turn my attention over to stock analysis just to kind of do the high level. So we are working with a company that is in Canadian dollars. No big deal. I think Canadian dollars are close to US dollars. So 72 cents. So a Canadian dollar is 72 US cents. So, okay. And a while ago, okay. So I forgot when, but it was close to 1-to-1. All right. So $64 billion market cap, a billion, and not Canadian dollar. So that's going to be like 70% of that. So this is like 45 billion US dollars. Forward P is 19.75. That's looking pretty good. Growth. See, they're growing here. They're growing 15%, 19, 26. Now, some of these numbers, you see that these guys are like a holding company. So it could be that they acquired a business and put it into their portfolio. And acquisition revenue is not as good as organic revenue. 15 is very respectable. And when we look at earnings per share, $32.42 Canadian dollars. Okay, free cash flow, 2.5 billion Canadian dollars. So if I do that in my head, we're talking about 1.8 billion in free cash flow. Okay. All right. Let's look at their balance sheet. Make sure we don't have a bunch of debt. So they have almost 4 billion of cash, 7.5 debt, debt to EBITDA 2.66. We're okay. Gross margins are a little low. Software companies should have high margins. I think I showed you a few software companies that are 70 to 80% gross margin. So why are these? I think because they do professional services and other things, which really drive down margins. Okay. So this business is not looking like a full-fledged software company. It's looking like a collection of software companies, which is not as good. Wow, look at that chart. So the whole AI scare is really selling the stock off. From May of 25 to now, the stock's down, 40%? That's pretty rough. That is pretty rough. Let's do a quick valuation on this one. And that one there, we went over Intuit earlier, so let's compare it to Intuit. Intuit has had very good organic growth in its history, but it also has grown through acquisition more recently. Now, it doesn't do acquisitions like every year or does an acquisition like they've been around for like 40 years. That's not an exaggeration. And they've acquired businesses like big businesses like twice. So they're not an acquisitive company. They're more of, hey, let's create an awesome product that is going to grow and create organic growth. All right, so we are going to do Constellation Software, and the ticker is TSXCSU. So they're out of my home country. So I'm going to go up a little bit, and I'm going to go up a little bit more on the risk level. Their balance sheet wasn't perfect, so I'm going to increase that. Now I'm going to go ahead and take a look at another screen you guys can't see, but that way I can do my data entry a little quicker. So let's start with cash flow. So their cash flow was... Let's do this. Let's keep this in Canadian dollars. All right, so free cash flow is $2,550,000,000. They're growing at 15%. 15 is fine. Then I'm going to bring this down to 12. All right. And then we've got cash. Let's see here. We'll look at the balance sheet and see what the cash level is. It was $3,910,000,000, and the debt was $7,580,000,000. And it's not pulling up my shares outstanding because Google lookups, they work really well for US based companies. So I'll have to type that in. No big deal. Shares outstanding, 21 million. shares. Okay. And why isn't this updating? So it's not looking up the stock price. Why isn't it looking up the stock price? Let me hit refresh real quick. Sometimes I just need to refresh sometimes I just need to refresh the sheet, and then it gets me what I need. And it didn't work. All right. So just not looking up those foreign amounts. No big deal. So 2922.01. So we're getting a modest discount of 13%. Earnings per share on this guy was $32, $32.42 Canadian. Now, these guys are not my favorite category of software. I like software companies that are growing, organically. So I'm going to go with a 20 PE. In fact, the margins were so low that I'm going to go 18. Remember, the margins were like in the 30s. I like to see the margins in the 60s, 70s, 80s for software companies. Growth rate, 13%. Let's go with 10 there. And this is where we're not getting there. Okay, so yeah, we're falling short. So Constellation Software is not an obvious huge opportunity. Right now, software stocks are really discounted. Really, really nicely discounted. Showed you Intuit, nice discount, super quality business. You got Adobe discounted, super quality business, CRM, ServiceNow, Path. I can go down the list, and I could literally list 20 stocks that are discounted that are software stocks, and they are organically growing. Constellation Software is made up of acquisitions. That's not as good in my book, and this is just not looking great. So for me, Constellation Software would be a sell. It would be a pass. I wouldn't want to invest in it. The chart has been quite brutal. So from the recent peak to where we're at now, stock's down 43.6%. Market's really getting after this stock. And I'd rather go into quality, high quality, and as mentioned before. So thanks for sponsoring that. I've never looked at Constellation Software. I didn't know they existed, but now I do. And I hope you found the analysis interesting. I'm going to delete this guy in a little bit. In case you have any questions, I'm going to keep it around. So all right. So we still got a lot of people on the stream. Thanks so much for attending. Thanks for all the super chats. Geez, we had 5 super chats tonight. Geez, that's awesome. Thanks, everybody. That's been stupendous. Thank you so much. So let me try to, man, I've been streaming for 2 hours. That is awesome. Time flies when you're having fun. So I think I talked about Wix and Path. I mean, I'm going to show you the valuations on those, but Mike, I mean, we're on the same page when it comes to software. The market just is turning away from software companies. Look at Wix. Look at this discount. Jeez. Incredible. And these guys are growing nicely, producing cash. They have a tiny valuation. I wouldn't be surprised if they get acquired because they have no real debt on the balance sheet. They're cranking out cash. This would be a nice acquisition for somebody. So Wix it's looking great. Path. Path is not growing fast enough. They got to grow a little faster, but even with the moderate growth, 36% discount. And I love that they're positioned in a place where the market should be growing, which is true AI software, machine learning software. They are in the right place. I really like that about them. Hey, thanks, Herdo. You are awesome, man. I think you've given me about 6 or 10 super chats. Thanks so much. Appreciate it. Going down to CLAR. CLAR is new issuance. Okay, now be careful with new IPOs because new IPOs, they look great and they sell off. It's kind of crazy, but it's like most IPO stocks, and they could be the highest quality stocks you can think of. They sell off in their first year. These guys have been around for less than a year and they're down 33%. So I'm going to give this one some time. I'm going to let us give some time, get me 2, 3, 4 more earnings announcements. And then I can make a real good decision. Right now, I see that they're discounted. Looks good. Looks really good. I like what they're doing. Buy now, pay later. I like it. I just need to give it some time. Give me some more earnings. Give me some more information. Tonight, I'm going to go grab some dinner. It's been an awesome stream. Thanks so much for tuning in and making it successful. And I will try to stream tomorrow morning with Daryl. If you can, join me, and it'd be great to have you. And good luck with your investments. Let's hang tight. It's been kind of a mixed market. I think we're going to continue to see kind of a mixed market. It really moved today. You had the semiconductor space really rally, some spaces fall behind. And then late in the day, some healthcare stocks began to rally, like United Health and others. We'll see what we have tomorrow. It'll be interesting. So thanks, everybody. Really appreciate it. And again, for all you members, be sure to use the terminals I created. Please give me feedback. I want to make these like super valuable for you guys. And I'd really appreciate your feedback, and I'll work on them. It's going to be a key area in 2026 for me, is making these terminals as valuable as possible for you guys. So you guys, take advantage of the research that we've been accumulating over the last couple of years. And the more research we do, the better we make this tool, the more value you get out of it. And I'll use your feedback as my compass on how I develop it. So that is it for tonight. Everybody have a nice evening, and I'll catch you on the next stream. Take care.